Here's something that happens to people who finally get serious about their finances, and it genuinely confuses them when it does. They pay off a credit card in full, aggressively, on purpose. The discipline of a lifetime finally paying off. And a few weeks later, they check their credit score and it didn't move the way they expected. Sometimes it barely moved at all. Sometimes, depending on which card and which other accounts they have open, it actually dipped slightly. That moment is genuinely disorienting for a lot of people because they've been told their entire adult life that paying off debt is unambiguously good for their credit score. And the honest answer is it's complicated in ways almost nobody explains clearly. Not because the system is broken or rigged in some sinister sense, because the credit score was never built to measure what people think it measures, and the specific mechanics underneath it sometimes reward exactly the behaviors that keep people financially stuck, rather than the behaviors that build real wealth. My name is Dave, and I love taking apart systems that everyone treats as obvious and showing you what's actually happening inside them. Today we're going through the credit score, what it's actually calculating, the specific mechanical traps built into the formula that most people have never had explained to them, and why optimizing for this one number can quietly work against the much more important goal of actually building wealth. Let's start with what a credit score is actually measuring, because almost everyone has a vague sense of this and almost nobody has the precise version. A credit score is a prediction. Specifically, it's a statistical estimate of how likely you are to miss a payment on debt within the next 24 months. That's it. It's not measuring your net worth. It's not measuring your savings rate. It's not measuring whether your financial life is actually healthy in any meaningful sense. It's measuring one narrow thing: the probability that you'll fail to repay borrowed money on time based on patterns in how you've handled credit in the past. The most widely used scoring model breaks this prediction down into five weighted categories. Payment history makes up roughly 35% of the score. Amounts owed, more specifically, how much of your available credit you're using, makes up roughly 30%. Length of credit history is about 15%. New credit inquiries are about 10%. And credit mix, the variety of account types you hold, is about 10%. Notice what's completely absent from that list. There's no category for savings rate, no category for investment balances, no category for net worth, no category for whether you're actually on track to retire comfortably. The score is silent on all of it, because none of it is what the score was designed to measure. That gap between what the score measures and what people assume it measures is where the trap actually lives. Let's go through the specific mechanics that create perverse incentives, starting with the one that confuses the most people: the utilization mechanic. Roughly 30% of your score comes from how much of your available credit you're currently using, called your utilization ratio. The lower the better, generally, with the best outcomes coming in under 10% utilization at the time your balance gets reported. Here's the specific trap inside this mechanic. A persistent myth exists that carrying a small balance month to month, rather than paying your card off in full, actually helps your score. This isn't true, and it costs people real money and interest when they believe it and act on it. What's actually true is more subtle. Your utilization is typically calculated based on your statement balance at the moment it reports to the credit bureaus, not your average balance throughout the month. This creates a strange mechanical reality. Someone who pays their card off in full every single month, but happens to make a large purchase right before the statement closes, can show high utilization on paper for that one reporting cycle, even though they have zero intention of carrying any balance and will pay it completely the following week. The score doesn't know intention. It only knows the number on the statement date. This means someone behaving in the most financially responsible way possible, paying in full every month without exception, can still see fluctuation in their utilization-driven score component based purely on timing, while someone who deliberately keeps a small revolving balance specifically to build credit is paying real interest for a strategy that provides no actual scoring benefit over simply using the card lightly and paying in full. The credit mix incentive. Roughly 10% of the score rewards having a diverse mix of account types, revolving credit like cards, and installment credit like auto loans, mortgages, or personal loans. Here's the trap. Someone with zero debt, no mortgage, no car loan, no personal loan, just a credit card paid off every month, is mechanically disadvantaged on this specific component compared to someone carrying a mortgage and a car payment, purely because the formula rewards variety of debt types rather than absence of debt. This creates a genuinely strange incentive at the margin. The formula in this one narrow component mildly rewards taking on an installment loan you don't necessarily need, specifically to diversify your credit mix, even though taking on debt you don't need is the opposite of wealth building. Nobody should take out a car loan purely to improve 10% of a formula. But understanding that this component exists explains why someone who has done everything right financially, debt free, high savings rate, strong net worth, can still see a credit mix component that scores lower than someone who is debt free. In name only because their installment loans simply haven't been paid off yet. The length of history penalty. Roughly 15% of the score is based on the age of your credit accounts, both the average age of all accounts and the age of your oldest account. Here's where this becomes a genuine trap for people who are doing the right thing. Once someone pays off debt and starts simplifying their financial life, a very natural instinct kicks in. Close the old accounts, reduce the number of cards, simplify down to one or two. It feels like decluttering, and in almost every other area of financial life, decluttering and simplifying is exactly the right instinct. In credit scoring specifically, closing an old account, especially your oldest one, can shorten your average account age and reduce your total available credit, which can push your utilization ratio higher even if your spending hasn't changed at all. The exact behavior that feels like responsible simplification, closing accounts you don't use, can mechanically work against the score. This is the clearest example in the entire system of the formula rewarding a behavior, keeping old, unused accounts open indefinitely that has no relationship whatsoever to actual financial health, and in some cases mildly conflicts with the instinct towards simplicity that tends to accompany genuine financial progress. Here's the question worth asking after walking through all three of those mechanics. If the credit score doesn't measure wealth, doesn't measure savings, doesn't measure net worth, and in several specific ways mechanically rewards behaviors unrelated to or even mildly in tension with wealth building, why does it dominate so much of the middle class financial conversation? The honest answer is that the score genuinely matters for one specific thing. It determines the interest rate and terms you'll be offered when you do need to borrow money for a mortgage, an auto loan, sometimes even for insurance premiums or rental applications. In that specific, narrow context, the score is genuinely useful and worth understanding and maintaining at a healthy level. The trap isn't that the score is meaningless. The trap is the conflation. Treating a debt reliability prediction as a proxy for overall financial health, then making decisions, keeping unnecessary accounts open, carrying small intentional balances, maintaining a diverse mix of debt types, specifically to optimize a number that has no relationship to whether you're actually building wealth. So, what does this actually mean practically? Because the goal here isn't to tell you to ignore your credit score. The goal is sequencing your priorities correctly. Maintain the score at a healthy level because it genuinely affects what you'll pay to borrow when borrowing is actually necessary, a mortgage being the clearest example. Pay every bill on time. Every time because that 35% component is the one piece of the formula that aligns cleanly with actual responsible behavior with no perverse incentive attached to it at all. But stop treating the score as a financial health dashboard. Don't keep a card open you don't use purely to protect average account age if it's creating temptation or complexity you don't need. Don't carry a balance intentionally believing it helps you, because it doesn't. And the interest you pay for that belief is a real cost for an imaginary benefit. Don't take on debt you don't need purely to diversify a credit mix component worth 10% of a number that itself doesn't determine your wealth. The actual financial health dashboard lives somewhere else entirely. Net worth, savings rate, the gap between your income and your obligations. None of those appear anywhere in the formula we just walked through, and that absence is the whole point. The credit score was never built to tell you whether you're winning financially. It was built to tell a lender whether you'll pay them back. Confusing those two things is the trap. And it's a trap the middle class falls into constantly. Not because anyone's being deceived, but because nobody ever sat down and explained the difference clearly. Now you have it.